The start of 22 has been brutal for the US stock market. Nasdaq tanked almost 16% in the month of January. And if you look at last 1 year movement of Nasdaq, the recent fall has erased all the gains of 2021. In fact, at the individual stock level, this fall has been even brutal, where some of the top tech companies have fallen as high as 50%. For example, Netflix crashed almost 50% from its peak in last couple of months. Amazon 10 almost 25% from its peak. In fact, recently Facebook tanked around 26% in a single day with a total fall of around 38% from its peak. And the list goes on. But as an investor, this could be the best opportunity to become a part owner of some of the biggest and the fastest growing companies of the world. America is the home of world's finest companies, and especially the technology disruptors that have literally changed the way we interact with technology. Right from Amazon to Facebook to Apple to Google to Netflix to Microsoft to Tesla, and the list goes on. These companies are not just the leader in America, but they are leading all over the world. In fact, there was an interesting analysis. The market cap of Apple is around $2.8 trillion. Microsoft market cap is $2.3 trillion. Google market cap is around $1.96 trillion. Against Nifty 50 market cap of $1.86 trillion. Then Amazon has a market cap of $1.5 trillion. So basically, the top 3 companies of the USA individually have more market cap than the entire top 50 companies of India. That's the scale we are talking about. Now you tell me, doesn't it make sense to be an owner in world leaders? So you might wonder, when the Indian economy itself has such a bright growth prospect, why should you invest in the US economy? So there are multiple reasons. The first reason is diversification. Diversification is a very important strategy in investment. There's a famous quote, "Don't put all your eggs in one basket." Now the Indian economy is fundamentally strong, but nobody knows the future with 100% conviction. We have seen multiple cases globally where many countries ended up in a hyperinflation state where the currency lost its value and you would need a sack of money to buy a packet of bread. So diversification in global countries like USA reduces your concentration risk in a single country. Another important reason is dollar appreciation. Over the last 10 years, the USD to INR price has jumped almost 50%. 10 years ago, 1 USD was equivalent to 50 INR. However, today 1 USD is equal to 75 INR. It means in US stock, you also have an upside potential due to the benefit of USD appreciation against rupee. And of course, the US is home of innovation, especially in technology sector that has a bright growth prospect. And especially now when there's a sharp correction, it creates an opportunity to invest in top technology companies of the world. Now the question is, how to invest in the US stock market? So there are multiple ways to invest. Broadly, you can invest either directly in individual stocks of the US market, or alternately, you can invest in the US market via mutual fund or ETF route. Within mutual fund and ETF, you can invest via active or passive option. Now within passive investment in US market, recently NAVI mutual fund has launched the NFO of NAVI US Total Stock Market Fund of Fund. This fund of fund would invest in units of Vanguard Total Stock Market ETF, which is one of the world's largest passively managed US based ETF and pioneer in the world of passive investment. So in this video, we'll quickly look at the direct versus indirect ways of investing in the US market, the pros and cons of both options. Then we'll look at how to invest in the US market via mutual fund and ETF route with both active versus passive investment options. Finally, we'll cover the newly launched NAVI US Total Stock Market Fund of Fund that would invest in units of Vanguard Total Stock Market ETF, which is one of the lowest expense ratio in the industry. Alright, let's get started. Now what is direct versus indirect route? In simple language, direct route means that you can invest directly in the individual stock of the US market. For example, let's say you want to buy Amazon or Facebook or Google, you can invest directly through LRS route. On the other hand, the indirect route means that you will invest via mutual fund or ETF, where you will give your money to the fund house and the fund house manager would invest in the US based ETF scheme, which in turn invest your money in the US market. Very simple. Both indirect and indirect routes have their own pros and cons. For example, if you select the direct route, you can choose the US stock as per your choice and also decide how much money you want to invest. Whereas with indirect investments, you can't decide which stock you want to pick for investment. So with direct route, if you make the right investment decision, you can fetch higher returns than the indirect route. However, wrong investment decision can also result in higher fall in your portfolio. So direct route is a high risk and high reward game. Whereas with indirect route, you might not fetch the highest return, but at the same time, your risk would be lower as mutual fund and ETFs are more diversified and managed by investment professional. Then in the direct route, you need to open a demat account and a trading account and need to convert INR into USD to buy the US stocks. This entire process of currency conversion has its own charges. Then again, when you sell your US stock, you need to convert USD into INR, which would again fetch currency conversion charges. With indirect route, you don't need to open a demat or trading account and you don't have to worry about currency conversion charges. Yes, here you need to pay a small fee to the fund house, which is the expense ratio. Moreover, the benefit of investment in US stocks via mutual fund is that you can start investing with as low as rupees 500. Now, if you ask me which option is better, then my answer would be that it depends on individual to individual. If you have enough time to research and pick individual US stocks, and if you have the appetite of high risk, then a direct option is better. However, if you do not have enough time for research and you do not want to take the headache of currency conversion and avoid the high volatility, then indirect investments via mutual fund and ETF is a better option. Now let's discuss the active versus passive way to invest in the US stock market. As discussed, you can invest in US market via both mutual fund or ETF. I hope you understand the difference between mutual funds and ETF. I have already discussed it in the past videos. In simple language, the key difference between mutual fund and ETF is that ETFs are also a type of mutual fund, but they are traded like a stock. So you can buy and sell ETFs multiple times in a day, just like a stock. Now you have both options of active versus passive way to invest in the US stock market. The key difference between active versus passive style of investment is that within active investment, the fund manager actively buys and sells the US stock and decide which stock will have how much allocation. Active funds claim to generate higher return than the benchmark and hence charges high expense ratio. Whereas passive investments simply replicate the benchmark and charges a lower expense ratio. Now over the last few years, active funds have struggled to beat the benchmark and hence people are now moving towards passive style of investment that charges a very low expense ratio. In case you want to read more, I have provided some news articles on how active mutual funds are struggling to beat the benchmark in the description. And recently, NAVI has launched NAVI US Total Stock Market Fund of Fund, which has a very low expense ratio. But please note that this expense ratio is not permanent and can change from time to time. So let's have a look at this new fund offering. So NAVI US Total Stock Market Fund of Fund would invest in units of Vanguard Total Stock Market ETF. Vanguard is the pioneer of passive investment in the world. So before we even discuss this NAVI US Total Stock Market Fund of Fund, let's first try to understand more about Vanguard and its history. I don't know how many of you are aware, but Vanguard is the world's second largest asset management company. And Vanguard has a very interesting history. It was founded by John Bogle in 1975. So John Bogle conducted a study in 1950s where he found that active mutual funds did not earn more money compared to broad stock market indexes. Even if the stock in the funds beat the benchmark index, management fee reduced the return to investors below the returns of the benchmark. And hence, he came up with the world's first passive mutual fund in 1976 named Vanguard 500 Index Fund that invested in stocks that are part of S&P 500 Index of the US. But for the initial years, Vanguard did not receive good response as it did not pay commission to brokers. And it was difficult for investors to digest the fact that passive funds are better than active funds. However, slowly, passive funds started getting attention when the returns from active funds were not able to beat passive funds in the US. And since Vanguard Passive Fund had very low fees, that is expense ratio, investors started investing money via Vanguard funds. So passive funds, which is still in its nascent stage in India, were launched way back in 1976 by Vanguard in the US. And today, Vanguard has a total asset under management worth $8 trillion. That's trillion and not a billion, making Vanguard the world's second largest AMC after BlackRock. Just to give you an idea, Vanguard total assets are way more than the entire Indian mutual fund industry that has asset under management of around $0.5 trillion. So the newly launched fund by NAVI Mutual Fund would invest in units of Vanguard Total Stock Market ETF that tracks the performance of CRSP US Total Market Index, which has 4,000 plus constituents across your small, mid and large cap companies, representing nearly 100% of the US investable equity market. Vanguard Total Stock Market Index Fund is the largest index fund in the world with an AUM of $1.3 trillion. So unlike having exposure to NASDAQ 100 that invest only in top 100 companies, US Total Market Index is more diversified that invest in nearly 4,000 plus companies as per their market cap. The benefit of this fund is that you don't only invest in the top 100 or top 500 companies, but also invest in emerging companies that are not part of top 500 list. Although the 10 largest holding of Vanguard Total Stock Market ETF still include your Apple, Microsoft, Alphabet, Amazon, Tesla, Meta, etc., that together forms around 25% of its total net asset. So investors still have exposure to top companies, but at the same time, they have exposure in emerging companies also that can become the global leaders tomorrow. Now, as far as returns are concerned, Vanguard Total Stock Market ETF has given a CAGR return of around 28.15% in last 1 year, 20.11% in last 5 years, and 20.27% in last 10 years in rupee term. So it has been a consistent performer. And since Vanguard Total Stock Market ETF is one of the lowest cost mutual fund, NAVI US Total Stock Market Fund of Fund that would invest in the units of Vanguard Total Stock Market ETF has an expense ratio of 0.06%, which is one of the lowest expense ratio in the industry. So in this video, we discussed the investment in the US stock market. After the recent correction, the US stock market is looking very lucrative from a long-term perspective. We discussed both options of direct versus indirect investment in the US market with the pros and cons. Then we discussed the mutual funds versus ETF and active versus passive way of investing. Finally, we covered the NAVI US Total Stock Market Fund of Fund that would invest in units of Vanguard US Total Stock Market ETF at a very low expense ratio of 0.06%. Although please note that this expense ratio can change from time to time. Vanguard has been the pioneer in the world of passive investment and the world's second largest AMC. Although we did have mutual funds and ETF in India that replicated NASDAQ 100 and S&P 500, we did not have a fund that replicated nearly the entire US stock market. And that gap is being bridged by NAVI Mutual Fund with its latest NAVI US Total Stock Market Fund of Fund offering. So this is getting really exciting. I think that it is just the beginning of low-cost passive funds in India that provides an opportunity to invest in India as well as globally at a very low cost. So what is your take on US stock investment? Do you invest in the US market? Let me know in the comments. In case you want to explore the newly launched NAVI US Total Stock Market Fund of Fund, I have provided the link in the description. I hope you will find this analysis useful. I'll see you in the next video. Till then, take care.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.